Digital Realty Trust stock, ticker symbol DLR. This stock is down 37% year to date, which is quite a lot, especially if you compare it to the S&P 500, which is down only 18% year to date. On the 26th of October, DLR presented quarterly results where they beat on EPS and revenue, but missed on FFO by only 1 cent. For the upcoming earnings, all analysts voted a miss for the FFO, so that's quite interesting. The reason why people love DLR stock is because of the dividends. A dividend yield of 4.44% and 16 years of dividend growth. But does this also mean that DLR stock is a buy at current prices? Well, in this video I'm going to show you real quickly what Digital Realty Trust does. The most recent earnings, the historical returns, the fundamental analysis, dividends, and in the last part I'm giving you my price target to see if they are a buy or not. And I think you definitely want to see that part, so make sure to watch until the end. And I'm also very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So, what does DLR do? Digital Realty owns and operates nearly 300 data centers worldwide. It has more than 35 million rentable square feet across 5 continents. And if we dive in the most recent earnings, we see some interesting things. The first thing that we are going to check are the financial highlights. They reported FFO per share of $1.55 versus $1.54 same quarter last year. So only an increase of 1 cent. DLR also updated 2022 core FFO per share outlook to 6.7, 6.75. DLR reported 787 in rental revenue, which makes up the vast majority of the operating revenue. The revenue is up 5% year over year, while operating expenses is up 9%, so this is something to keep your eye on, since operating income is down 14% year over year. The next thing that I want to check is the AFFO, probably one of the most important metrics for a REIT. AFFO per share diluted is at $1.5 right now, where it was at $1.6 last year, so that's again something to keep your eye on. Dividends per share are up from $1.16 per quarter to $1.22. Payout ratio is at 80% right now, which is pretty common for a REIT. But keep in mind that last year it was at 72%, so that's something that I don't like, of course. Nevertheless, it's still in the range of where I like it. If we dive in the earnings presentation, we see that the US dollar makes up more than half of the revenue, 56% to be precise. The euro makes up 21%. And DLR do what most companies do at these times, show the constant currency growth. For the revenue they reported 5.2% increase year over year, but with constant currency it's at 11.2%, which is quite a difference, and it's the same story with the core FFO per share. 3% versus 6.8%. And now that we know more about this company, it's time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe and in return you receive similar analysis to this one every week. Let's continue by diving into the fundamentals. DLR is a 31 billion market cap company, which makes them one of the bigger REITs in terms of market cap with a digital focus. PE ratio is at 21.9, but to be honest, PE ratio isn't the best way to value a REIT, so we are going to use a price to FFO to see its valuation. Price to FFO is at 18.49, which is a bit on the high side to be honest. I prefer 16 or lower. Later in this video I will show you my 3 price targets for DLR, so make sure to watch until the end. Revenue is at 4.57 billion, and in this graph we see that revenue went up really nice and steady, which is something that I really like, of course. Net income is at 1.43 billion, which gives us a profit margin of 31%, which is significantly higher than the 5-year average of 18%, so that's also something that I really like. EPS is also up in the long run, but not as nice and steady as we saw with the revenue. But to me it's more than okay since it's a REIT. Price to free cash flow is pretty steady over a longer period of time and is sitting at 11 right now, which looks pretty good to me. Analysts are expecting EPS to increase massively in the upcoming years, which is very interesting. Revenue is expected to grow in mid to high single digits in the upcoming years. Return on assets is sitting at 4.2%, which might be looking a bit low, but keep in mind that REITs have lower numbers here in general, so I'm not worried that much. It's the same story with the return on equity and return on invested capital. The good part is that return on invested capital is slightly up versus the 5-year average. Current ratio is at 0.64, which is also looking pretty good in my opinion, so nothing special to mention here. A thing that I don't like is the debt to cash ratio. Right now total debt is sitting at 17 billion, while total cash is at 176 million, so they have a lot of debt, which worries me a bit. But keep in mind that REITs have higher debts in general. And a great thing about this company is that free cash flow is growing. And this is something that I really like, of course, since free cash flow is used to pay down debt, but also to buy back shares, do acquisitions and all other things. And if we check the shares outstanding, we see that it's going up big time, which is something that I don't like. But keep in mind that REITs are a bit different when it comes down to shares outstanding. They issue new shares to raise capital and grow the business. So again, I'm not worried that much. Next up are the dividends. Dividend yield is sitting at 4.44%, which is pretty high of course, and attracts a lot of investors. Annual payout is at $4.88, and the payout ratio displayed here isn't correctly. Earlier in this video we saw that it's sitting at 81%. The 5-year growth rate is at 5.6%, which is not that high in general. But for a REIT it's pretty okay. On top of that, dividend yield is already pretty high, so 5% is pretty good in my opinion. DLR grew the dividends for 16 years in a row, which is pretty impressive. Overall, a great looking scorecard. But how about the historical returns versus the S&P 500 and some competitors? I decided to include the S&P 500 as a benchmark, since this is one of the easiest ways to invest. Just buy an S&P 500 ETF and wait. Next to that, I decided to include SBAC, ARE and BXP, all competitors of DLR. On the 5-year chart we see that DLR returned only 10% including dividends, so that's not very good of course. The S&P 500 returned 68% including dividends, so you were better off owning the S&P 500 in the past 5 years. SBAC outperformed the S&P 500 big time with a 83% return, and both ARE and BXP underperformed the S&P 500. On the 1-year chart it's pretty much the same story. All stocks underperformed the S&P 500 except for SBAC, which beat in the S&P 500 by a tiny bit. On the 6-month chart it's looking pretty bad for all stocks. The S&P 500 is the winner here with an almost flat return, versus a minus 9% return at ARE and SBAC. DLR underperformed again. On the 1-month chart, things start to look a little bit better for DLR with a 21% return versus 10% return for the S&P 500. SBAC is again the winner here with 22% return. Overall, DLR had a very low return. But what does this mean for the future? Could DLR stock be a buy at current prices? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 5, 8 and 11% based on what we see in the analysis and based on what the analysis estimate. For the profit margin I'm filling in 22, 26 and 30%. For the free cash flow margin I'm filling in 36, 38 and 40%. For the PE ratio and price to free cash flow I'm filling in 16, 17 and 18. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now DLR stock is at $109. I hit analyze and we see a few green numbers here. And since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $83, a mid price target of $113 and a high price target of $154. To me, the mid-price target is the most justified here, so that would mean a potential profit of around $4, which isn't a lot of course. My final conclusion on this stock is that I really like the business and most parts of the stock as well, but the valuation is a bit on the high side. They are not overvalued in my opinion, but with the price target of $130 and DLR stock sitting at $109, I want a high margin of safety. So this stock needs to drop to around $80 to $90 in my opinion to become interesting, which is quite a big drop from here. So for now I'm skipping this stock and wait for the stock price to come down even more. From there I'm going to analyze this stock from time to time. And remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I would really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.